Doug, you manage money. You do it for a living. You do it across a number of different types of individuals. Can you take us through what the conversations are like right now with markets at record highs? Is there any sense of worry? Do people feel as though there could be a shoe to drop anytime soon?
Yeah, I feel like people really ask that question. Well, what do we do now? What do we do that we're at all-time highs? Should we be more defensive? Should we take some, risk off the table? And most people are looking for some level of action right now. And the interesting thing is that all-time highs usually bring about new all-time highs here. So we don't want to abandon our strategies. If we're having a long-term outlook, we want to maintain that. It's about consistency and discipline. But now might be a great time to actually rebalance those portfolios. If you've gone from 80% stocks to 20% bonds, and that has gone up to 85-15, bring that back down to 80-20. Take a little bit of those gains off the table, get back to that target allocation.
Now, there's been a trade that's been happening in this magnificent seven part of the marketplace. It's been almost a self-fulfilling prophecy, right? Because if you're invested in index funds, and those index funds are market cap weighted, and it's the names like Microsoft and Apple and NVIDIA specifically that have been driving the results, how exactly then do you view that Mag 7 trade, and do you take profits there, and how exactly do you go about doing it?
It's a really great question. When you're indexing, you're getting exposure to these weightings. Now, some people say, hey, go look at an equal cap weighted index fund if you want to really level the playing field amongst those magnificent seven stocks. However, that's lag performance. You want to be a part of the winners here. Being an index investor will allow you to constantly be in tap with what is changing. So if something falls out of that index or, has less of a weighting, you're going to participate in that as well. So it's usually, not a great idea to say, hey, let's be tactical here and, stray away from the things that are performing. People are usually pretty happy with what's going on right now because they have exposure to those winners.
So let's talk about the momentum as you see it. Let's say an investor, a client, has a core index type weighted investing philosophy.
Sure.
And then they add things on the periphery to kind of add alpha, outperformance. What exactly is that alpha, and where does it come from right now?
Sure. So we first want to acknowledge that it's not all S&P 500. It's not all Magnificent 7. You look at risk-adjusted portfolios, and you're getting exposure to mid-cap stocks, small-cap, international, developed, as well as emerging markets, and even fixed income, where there might be opportunities right now. You're getting that exposure across the board. Some clients might actually say, hey, I want to go a little heavier on technology, if you can believe it, because it's been the performer, or they want exposure to other sectors. Sometimes you see digital assets taking place in portfolios now that you have Bitcoin ETF out there. You get some non-correlation along with that. So there's many ways to do it. It's not always, hey, let's dump all of our money in the S&P 500. We're getting exposure across all major asset classes.
And I'm sure you have clients who are income oriented.
Sure.
Right now, the yields are relatively high compared to where they've been. Is there still opportunity? You mentioned fixed income. Where is it?
Yeah, so you have the Fed signaling that rates, you get one, maybe two rate cuts this year. If you took them at their word on the front end before they raised rates about 11 times here and went short duration, you did well. You avoided the worst bond market in 100 years in 22. Now you're perhaps going to go the other way. They're telling you we're going to lower rates at the back end of the year. So you can get higher yields on your fixed income as they are right now. So if you have some, extra cash here beyond your cash reserve, now might be the time to say, hey, I don't want to be participating in those falling rates. Looking to longer duration fixed income might be a way to lock in those yields and also get some appreciation for when rates do go down. So there might be some opportunities here in fixed income.